the basics of TA, right? TA is an understanding of how the market has behaved historically, right? And using certain parameters, certain rules, and following some trend-based systems to analyze or to predict in a way, right, with probability what is going to happen in the future, right? Now, it is not a prediction of certainty, it is a prediction of probability, right? That is a very important distinction you have to understand. Because if it was a prediction of certainty, then there would be no risk mitigation. You wouldn't need to put stop loss because it's a certainty. The reason you put a stop loss is because it's a probability. There is always that it could go wrong. It might not work out, right? So the first things you should do always when you're looking at a new chart is to try to understand the overall trend. Now, in a chart like this, if it makes you a little bit easier to invert the chart, to look at it from the other perspective, you might see things a lot more cleaner, right? And looking at it from a perspective of, you know, this being the bottom, which currently it is, and we're in an uptrend, right? Now, how do we know we're in an uptrend? Is currently we are holding, or we held the previous highs and are currently going up from it. So how does this uptrend retained? How can this be retained? You want to be holding the high of the previous ranges, right? Because markets move in a staircase momentum. So you want to hold the high of the ranges. Now we have now you might think, okay, so none of this levels below this matters. Correct. The only thing that matters right now on Spotify is this range. Anything else does not matter right now. And it will only matter after we lose this. Right? Because it's a step-by-step process. You are not jumping steps. Because if you start jumping steps, things become a lot more unclear, because you might think, okay, what if this is the level to hold? What if this is the level to hold? What if this is the level to hold? It doesn't matter, because we haven't done anything that indicates that we're going to come down here yet. So first indication is continuation up. Okay, now we're going to zoom into the smaller time frames. We're going to go to the dailies and the weeklies and have a gander, right? Okay. What are we doing on the dailies? Right? Still an uptrend. Potentially break of level. Okay, there's a potential there. So we did lose this level here, which was the local level that took us up, right? We did have closes below it. When I say losing levels, I'm looking at closes below this range. And in this case, we have multiple closes below this range, right? So there's a potential indication of some sort of a reversal at this range. But that potential isn't going to be verifiable. It is not going to be looked at, because this is optimally what you're looking for to happen, right? Now you might argue and say, okay, if that is the optimal trade, then why not just take the short here? Wouldn't it be, or in this case, take the long here, because this is an inverted chart, right? Why not just long here? Now, longing here is an indication that you are certain towards the trend of the market. And as I told you before, TA, or the analysis of TA, isn't necessarily about certainty, it's about probability. And how is probability calculated? Probability is calculated because something does something, right? If it loses this level, there's a higher probability of a continuation down. If it does not lose this level, means there's not a higher probability of a continuation down. So what does that mean? It means there is no trade. Now, let's assume you have a long, or in this case, you have a short on this trade, and you're looking for an invalidation to your trade. Your invalidation to your trade is somewhere around here. So this is where your stop loss is. Or if you want to be a little bit more aggressive, it's around here. Because until we have closes above this range, it is going to go lower and lower and lower. Now, you could take longs. And I'm not saying you can't. You could. But what you have to understand is you are taking trades on a retest. So you have to be very clear with yourself and with your TA that probability is it is not going to go higher than this. So I would need to take profits here, or at least close a decent amount and move my stop loss into profit. Because until I move my stop loss into profit, it means that either I'm going to lose money or I'm just going to get out break even, which is not really a good thing, right? So you want to get out in profit if you can. And the idea is this is your local resistance. So you simplify it. You go, okay, if this is my local resistance, I'm definitely going to take profits. Now, that does not mean that it can't go higher. That is not the point. The point is you are taking profits at optimum ranges. Because you can just take profits here, move your stop loss to here, right? Because if we do go to this range, what will be the level to hold? So having stop loss below here seems optimal to me. Because we would need to hold this and continue. But not only is going to give you an indication of where the invalidation is, but it's also going to get a potential indication of where you can take another trade. Or you can add to this trade, for example. Right? So that is how you materialize a trade. That is how you calculate, and that is how you understand a trade. Now, after you've had that general understanding of where I'm going to take the trade and where my stop loss is, you need to be realistic with your targets and say, okay, what are you looking for it to do? We've already tested this, so we already made a new high higher than this, so we've already tested that. What is the next one? The next one is here. Okay, so that is your target, that is your entry, and that is your stop loss. Is it optimal? Is it above for risk to reward? The answer to that question is yes. So, when you are taking trades, there are 4 rules or 4 things that you should be generally looking at. Firstly, you are taking trades that are for risk to reward and above, and you use your first PT as that risk to reward calculation. That's the first thing, right? Second thing you're looking at is moving stop loss after second PT. Always. Always. Third thing you are looking at, right? Okay. Is always taking trades after a retest. You don't, majority of the times when you're taking trades, you don't want to take trades on the impulse, right? Because impulse is majority of the times not always the case, right? There's always an exception to the rule. But majority of the time, you are always looking at it from a perspective of, okay, I'm going to wait for it to close above and gain above. I want multiple closes on the hourly or the 4 hour. And then I'm going to take the trade with stop loss and my target, which are realistic. So these are majority of the times you are using this sort of a mechanism to take the trades. And it's the same thing on the inverted when you're taking shorts, for example. It is the same system. And it's very basic system, and it is basic, but it's very, very important. Because majority of the times, the most profitable of trades, right? The most profitable of trades are the trades that are reversals. That give you the most optimum risk to reward and the most optimum profitability, right? So trying to understand when the reversal is going to happen is not only suitable, but is paramount to become long-term profitable in the markets. Now, I'm not saying that is the only way. It might be other ways. Like I said, there's exception to every rule. But this is the most optimal slash, I don't want to say easy, but optimum slash consistent way that you can analyze things, right? So only taking trades after a loss or gain of levels. Now the question now arises, what is a loss and what is a gain? Now this is something that you need to look at and watch and pay attention to, and this is where it comes from a perspective of you need to watch live trading, you need to watch live TA, you need to watch live price action and teaching of live price action and have an understanding of what's happening, right? Because that is what you want to have in your brain, because that's how you learn. You learn by osmosis. Trading is about learning by not only doing trading, but also watching live TA, where it's not hindsight. It is, this is what has happened, and because of this, this is the likely scenario to be happening in the next couple of days, or the next couple of weeks, or whatever, right? And fourth, and probably the most important, is risk, right? Where you're only risking 0.5% of your account, right, per trade at any one time, right? It doesn't mean that you take a 0.5% risk on Bitcoin and then 10 minutes later you take another 0.5% risk on ETH, and then another 10 minutes later you take another 0.5%. No, it means 0.5% risk, including of course the fees. I mean, that's obviously self-explanatory, right? At any one time. Now, that doesn't mean that you can't take multiple trades. You're just going to have to divide your risk accordingly. Or you can do it the way I do it, which is I take a new trade, and let's say hypothetically it pumps. Now I want to take another trade. What I'll do is I won't take the trade on this stock or on this ticker. I'll take the trade on ETH, for example. Let's say I took a Bitcoin trade here and it's looking good. So I've taken some profits here, let's say hypothetically. Now let's say my stop loss is already in profit. Now I have a 0% risk trade running right now. Why is it 0%? Because my stop loss is in profit. So I can afford to take an ETH trade where I just take this trade. So I have two trades running right now in the same direction. But the difference is, at any one time, I only had a 0.5% risk. Right? So that is one of the reasons I have, 60 plus shitcoin trades running right now, and 30 to 45 plus crypto trades running right now. Is because after it hits second profit target or third profit target, and I move my stop loss to profit, I don't really care about that trade anymore. Right? Because I'm not going to lose money on it. The stop loss is already in profit. Me staring at the chart, me staring at the trade doesn't do anything to it. So I rather spend my time taking a new trade. Right? So that is why this is very important, because not only gives you consistency and rules to follow, but it also gives you a plan towards expediting your capital. Right? Because as soon as you put your stop loss into profit in one trade, you can move on to the next trade. And the next trade, and the next trade, and the next trade, and the next trade. And what that does to your brain is you start being less and less married into trades. You start becoming less and less caring about your trades. So now you've distinguished your emotions from your trades because you're moving on, right? You're hitting, leaving, right? Smash and leave, right? Right? So that is why it's so important, because you are brainwashing yourself into not caring. Because caring about trades and caring about money is such a human thing to do. You have to go against that psychology, and it's very hard to do. That is why 95% of the people out there don't make money in markets, because it's hard. Because if it wasn't, 95% of the people wouldn't be making, you know what I'm saying? Like, you have to think this way, or you have to think something like this. I'm not saying you have to follow these rules. I'm saying these are the rules that I follow, and these are the rules that I, in my opinion, is the easiest to follow, because you can just bullet point them, print it out, put it right in front of your screen, or put it in the wall somewhere, and as soon as you want to take a trade, you go, okay, is it for risk to reward? Tick. Okay, this obviously doesn't matter when you initiate a trade, right? This one matters. Tick. This one matters. Tick. This only matters, the number 2 only matters when you're managing your trades. And managing trades is also very hard for a lot of people, right? Like, you've understood yourself many times, I'm sure, that you've been in a trade and you think to yourself, okay, I think it's going to go higher. I believe it's going to go higher. So what I'm going to do is I'm not going to take any profits around this range. I'm not going to move my stop loss to profit, because, but what if the market does a retest and hits my stop loss, I get stopped out, and then it pumps. You start becoming that fearfulness, right? About what could happen. And how many times has it been where you've taken trades and you haven't managed your trade optimally, where you have been too aggressive or too laissez-faire about the trade? Laissez-faire meaning you're a little bit like, oh, you know, it's going to go up. You know, I don't need to care about it, about the trade, and your stop loss isn't in profit. The only time you want to be laissez-faire about your trade, meaning that, you know, I don't really care. If it goes high, I make more money, is when and after your stop loss is in profit, where there's zero risk involved. There's actually a positive involved. But people do that when there's negative involved. People do that when their stop loss is at loss. And they think, okay, you know, I can wait for it to go higher. And majority of the time this happens when you're actually making money in markets, not when you're losing money. Because a switch flicks in your brain and then you tell yourself, you know, I can afford to lose. Why? Because I made money. And then you start thinking emotively rather than logically. You start throwing your plans out the window that actually made you money in the beginning. Right? And after you take one bad trade, you go, okay, it's not that bad, you know, I still have the money. You take another bad trade and you go, okay, you know, it's fine. Another bad trade, and then you go, okay. Now you start revenge trading. Now your psyche has moved from idea of making money to idea of making money back. Because you knew you could make money before and how easy that was, or how hard that was. Now you're trying to get that hit. Now you're trying to get that rush. Now it becomes about revenge trading rather than anything else. And now you've gone down the rabbit hole, and it's going to be a never-ending domino until you sit back and then you look at yourself and go, why the fuck did I do that? And you're not going to do that until you're in negative. And by the time you're in negative, it's already too late. because now you're already emotionally scarred about trading. Because next time you take a trade, you're going to think to yourself, well, last time I did this, I lost money. So what if I lose money this time as well? Right? So there is going to be a lot of hurdles. Even if you follow these rules, there's going to be emotional hurdles. Now, there is a way to dampen those hurdles. And there's a couple of rules I would say to not necessarily you need to follow, but think about, right? First rule is the reduction of risk. Let's say you took a trade, right, where you're risking $100. So if you know, I was going to do 100% there for a bit. If you were to lose money, you lose $100. And you're fearful to lose $100. Well, what if it's $50? Are you still fearful? What if it's 25? What if it's 10? You're still going to take the trade. But I hope you guys agree, you're going to be less fearful to take this trade than this trade. And that is where the nuance, the nuance is you're still following these plans and you're still taking the trades, but you're risking so little that you don't necessarily care that you are going to lose. And this is how you brainwash yourself into embracing stop loss. Because no one wants losses. But what you have to be realistic towards is you're going to get losses. And you have to embrace that. And it's very hard to embrace that in the beginning. So you have to brainwash yourself a little bit into embracing it and cheat yourself, your mindset, into embracing losses by embracing smaller losses. You're still losing, but you're losing a lot less than you would have. So that's why it's so important when you are fearful to reduce risk. Oh, I don't want to take this trade here because I'm uncertain about it. I've planned it out. It ticks all these boxes, but I'm fearful because I don't want to lose money. So rather than losing $100, take the trade, but you're only going to lose $10. Follow this rule and take the trade that you're only going to lose $10. But take the trade. Right? Most people, when they're fearful, they don't take the trade. And I always like to quote, the boy Genghis Khan, right? If you are, right? If you're scared, don't do it. But if you're doing it, don't be scared. So if you planned it out and it follows all the moves and you're thinking of doing the trade, don't be scared. You already know what you're going to lose. Right? So what it does is it reduces your fear. And not only that, but you brainwash yourself into thinking less emotively and more logically.
Skinner, I want to catch the bottom.
Right? Because whenever people ask and go, oh, why do people trade this way? Why do people trade like a machine? Or why do people trade using logic? And you go, oh, it's easy, just do it this way. It is not easy. Human beings are emotive beings. It is not easy. You have to brainwash yourself. You have to trick yourself into thinking this way, especially in the beginning. Right? You have to follow strict rules. Right? It's like when you try, when you're relatively fat and you're trying to, lose weight. You have to follow strict regimes. Right? Because otherwise you just want to eat. It's a human psyche to be comfortable in what you're in. Right? And for you to be uncomfortable, you have to brainwash yourself to be uncomfortable. Right? And the uncomfortability we're talking about here is the idea of losing money. No one wants to lose money, but you have to be realistic, right? Because no one has 100% hit rates in the market. It doesn't exist. So you are going to lose money. The question is, what are you going to do when you lose money? And this is the answer to the question. If you're following these rules, if you have this mentality, you're going to be less scared of losing $10 versus losing $100, for example. Because now you know the unknown. Exactly. Right? The unknown, the darkness is fearful, but you're going to the darkness with a flashlight. You're going to be less fearful. It is still scary, but it's a lot less scarier because you're following certain rules and following certain parameters. And this is very hard in the beginning. It is not easy. But this is the way. This is the way. This is how consistency is born, and this is how consistency is created. And trading, when it boils down to it, it's all about consistency. Come on, baby. Consistency in your thoughts, consistency in your process, and consistency in your profitability. If you hit these three targets, you don't need to aim to make money. You will make money passively. Right? Because if you start thinking, I need to make money, you are thinking emotively rather than logically. But if you're thinking in terms of, I need to follow these rules and these parameters, and you do it almost automatically or more systematically or robotically, whatever you want to call it, it is going to be a lot more easier for you to follow because it doesn't involve emotions, feelings. It is a bullet point, it is a tick box, and you tick those boxes. And it makes life a lot more easier, a lot more calculable, and a lot of this is used, and you need to use a trading journal. Because if you fuck up, how do you know you fucked up? You don't need to buy, the trading journal courses, or you don't need to buy any of that shit. Just get an Excel file, and all you need in your trading journal is the date of the trade, the ticker, or the currency pair, or the shitcoin ticker, whatever it is that you're trading, where your entry was, where your stop loss was, where your first profit target was, where your second profit target was, what was the risk to reward for the trade, right? What was the risk for the trade in terms of percentage? And did the trade work out? Maybe a chart. That's all you need for that trade. How long does that take? Maybe a minute, maybe 1.5 minutes, maybe 2 minutes. How many trades are you going to do in a week? 10, 20? That's all you need. Because that way you can go back and check, did I follow these rules? Or did I just willy-nilly took a trade because I felt like it? Because I felt that it was going to pump. I felt that it was going to dump. FOMO, FUD, all that shit. Right? So it removes the thinking of emotively. And it inputs the thinking of it logically and systematically. And that is what leads to consistency in trading. And that is what leads to profitability in trading in the long term. Any guy can be profitable in the short term. You've all been there before. You've all made some money in markets before. But the trick is to keep that money. The trick is to hold on to that consistency of your earnings, which I'm sure you guys know, that is fucking hard. But it becomes a lot more easier if you follow certain systems and you follow certain rules. And hopefully this beginner session helped you to understand some premise towards the understanding, a basic understanding of the psychological mindset and also TA mindset towards trading and how you should think potentially and how you should trade. All right. So the TLDR is 4 rules that you would be looking to follow. Number 1, 4 risk to reward and above per trade. And you'd calculate your 4 risk to reward by using your first profit target. Second rule, moving the stop loss after your second profit target Third rule, only taking trades after a loss or a gain of levels. So you're taking confirmation trades rather than impulsive trades. And the fourth, and maybe the most important rule, is risking 0.5% of your account per trade at any one time. And if you're still fearful that you don't want to lose 0.5%, reduce it, half it to 0.25. If you're still fearful, half it again, until you get to a point where you're not fearful anymore. Okay? Because the aim of the game isn't necessarily when you're starting out to make as much money as possible. The aim of the game when you're starting out is to have a system that you can do consistently that makes you some money consistently. It is not about becoming a millionaire tomorrow. It is about making $10 extra that you didn't have yesterday. Making $20 extra that you didn't have yesterday. $1,000 extra what you didn't have yesterday. $10,000 extra what you didn't have yesterday. It's about the consistency on your earnings. Because until you have that figured out, you are going to give your money back to the market all the time. All the time. It might not happen tomorrow. It might not happen next week, but it is gonna happen in the future for majority of you people. It's not gonna happen to everyone. There's an exception to the rule. Are you the exception? No, you are not the exception. You are the rule. Okay? And that's it. That is my rant / teaching moment about the basics of TA and the basic mentality of TA. And that's about it. Cheers. All right. How long was that? That was actually pretty relatively long. Anyway, that's the recording.